away from the theatrics by some of the opponents, right? There's a lot of strategic stakes on the line when it comes to the stablecoin legislation, right? I'll point to remarks by Secretary Bessent when he was giving his testimony, where he was summarizing the results of a TBAC presentation. So the Treasury Borrowing Advisory Committee was charged to essentially study the impact of stablecoins on a wide variety of kind of more market structure elements in the USD kind of global and domestic financial system. And they did a very serious, like, in-depth analysis. The most in-depth analysis, the most kind of definitive statement of kind of their policy kind of market analysis to date on this topic was just released on April 30th, and it's called Digital Money. And I'm encouraged, folks to like flip through the deck, right? Because it actually has some really interesting statements in there, right? In particular, a forecast pending certain assumptions around the passage of the Genius Act that the total sort of stablecoin market supply will increase from roughly $230 billion today to $2 trillion by 2028. It's like an 8.3x increase. And they also point out that right now about 120 billion, I have to go check the numbers, 120 billion of that market cap is basically held in T-bills. And so they forecast that to increase to about $1 trillion in T-bill supply, held on the balance sheets of stablecoin issuers. And so $1 trillion is like anywhere from, I think it's about a $6 trillion total T-bill market. But that amount of issuance is like almost the U.S. government's like annual issuance of T-bills. So this is the Treasury Department essentially forecasting the growth of these balance sheets in a fashion where they become a strategic demand source for U.S. debt, right? And this is something that BPI has written about for years now as like a forecast and a strategic potential. And in particular, the relationship between Bitcoin and stablecoins is quite tight, right? Like the correlation between the overall growth in the US dollar price of Bitcoin and the amount of US dollar stablecoin liquidity is like, depending on how you do the correlations, anywhere from 60 to like 80%. The causation is probably multifaceted, right? Like overall global liquidity creates additional buying power for Bitcoin, but endogenous demand to hold Bitcoin requires people holding stablecoins in order to intermediate those transactions, which are like 70 to 80%, on stablecoin rails. And so this is this flywheel that the U.S. Department of Treasury and the Treasury Secretary himself is like pointing specifically at. And they want to, as a matter of policy, sort of engineer this linkage between digital assets in general and U.S. sovereign balance sheet. And they even in the deck, use the term USD hegemony, right? How stablecoins can expand the dollar system outside, and they make an analytic assessment that the something like a Genius Act would have probably a net neutral effect on the domestic US dollar money supply. The real expansion of the US dollar money supply is in the offshore system, where stablecoins can also play this interesting function, not just as a medium of exchange, right, for parts of the world where there's lots of frictions to use the dollar in everyday commerce, but as a form of collateral, right? Because it's a stable token that has a dollar symbol next to it. You can use this as essentially collateral in offshore dollar transactions, which frees up a huge amount of additional, kind of demand and overall market activity around and in the dollar, right? But bypasses kind of the traditional kind of hierarchical corresponding sort of banking systems, and in particular, sort of bypasses the foreign central banks, and kind of creates this separate network that you can imagine. The legacy network was kind of hierarchical. All the dollar payments get cleared through chips and the New York Fed, and then swap lines help ensure the stability of the global eurodollar system, which are IOUs essentially on the balance sheet of non-US banks. But essentially, they're rehypothecating that collateral, and if they get into any sort of trouble, if there's any sort of run risk on those dollar claims, their national central banks have to bail them out with dollars. Where do those national central banks get those dollars from? The Fed. So you can imagine this, like, think about like a network growing, right? You have the legacy kind of hierarchical banking system that sort of is managed through the Fed, but uses global central banks as its kind of as its agents. This is the Treasury Department saying we want to help nurture the growth of a kind of a systems bypass or an alternative network that goes sort of straight to those markets themselves. And I think there's, at the same time, right, like impose a bit of financial repression on those holders of that dollar token overseas, because at least in the current, framework, there's no interest bearing kind of stable coins allowed. So this is like the strategic stakes, right? This isn't like a onesie twosie little few $billions. These are fucking trillions of dollars and a material portion of the U.S. government's debt servicing over the next few years.
Yeah, man, I'm sure you have more developed thoughts on this than I do, but I was thinking a lot about, what is the relationship between, stablecoin proliferation and the eurodollar system. And so probably some of our listeners will be familiar with what the eurodollar system is, but really it is using dollars abroad, not directly as a medium of exchange or store of value, but actually either as a, depending on the terminology used, as a unit of account to price things in, or a standard of value, I think is the more accurate term for like what you want to be paid in the future. And it creates all of these IOUs. And no doubt that does create some demand for treasuries abroad, because if you have a lot of dollar denominated liabilities, a bunch of IOU that you're pricing in dollars, you do need at the end of the day dollars to pay for them. And that relates to a lot of stuff we previously talked about on the show relating to Triffin's dilemma and, creating demand for dollars abroad and why we send pieces of paper overseas in exchange for physical stuff. And it also creates this sort of, quite popular meme in Bitcoin macro land about, dollar milkshake theory, in that, when you have a sovereign debt crisis, the dollar actually holds up quite well and appreciates greatly relative to other fiat, because everyone has dollar denominated liabilities and there just is a natural shortage of dollars. But it seems like when, instead of just basically countries through the eurodollar system being naked short dollars, having dollar liabilities that they may or may not have any collateral from, they actually have the thing. They have a bearer instrument that is one-to-one backed by dollar or dollar equivalents that can, both be the medium exchange and the store of value, and, is very different than, just dollar IOUs. Do we think that this changes any of the dynamics of Triffin's dilemma, or changes the dollar milkshake theory, or any of these, things that people are worried about, like the status of the dollar itself as a wrecking ball?
I mean, that's a complicated, multifaceted kind of macro finance plumbing question. I'd say, just stepping back, there's already been some structural shifts, non-crypto related, right? In the move from LIBOR to SOFR, which you can imagine moving from an unsecured to secured and an offshore to an onshore kind of global dollar system. So that shift's been sort of years in the making. It was sort of started under Trump 1. And it's been, kind of a successful kind of monetary restructuring in terms of how the U.S. government has kind of embedded demand for U.S. Treasury securities in the global eurodollar system, from being sort of naked IOUs that were sort of very, very lightly collateralized, meaning you could sort of rehypothecate the same Treasury security, to expand liquidity in the offshore dollar system. And that created, a lot of elasticity in that system, but also meant it was prone to run risk. As soon as there was a hiccup in some, in the global economy or in some even regional economy, they became, the scarcity of dollars, either because overall economic activity goes down, they just, trade falls, and those dollar inflows are not sufficient to support that stack of IOUs, right? Then people scramble for the dollars, and that kind of creates the sort of dollar milkshake cycle. Of course, that's not like a problem that the folks managing the system were unaware of, but it was like a hard thing to kind of shift. And so the first step in shifting that was kind of moving to SOFR, secure overnight financing rate, which basically, it's a long, complicated story, but essentially is designed to sort of shift the marginal dollar kind of transaction to a secured standard, where you have to have a piece of collateral, essentially. And so that structurally increases the amount of demand for Treasury securities, right? So essentially lowers the overall kind of leverage in that offshore system, but it doesn't make it go away, right? And so then stablecoins are kind of now coming into that environment as a new thing. 2 trillion is a lot, but compared to like the total stock of outstanding debt, it's still maybe 10% of that market. And so will it have this sort of strategic impact, shifting the balance of how most trade happens? This is, I think, the really interesting, maybe like conservative assumption that T-Back doesn't get into, which is, you look at what Tether is really up to, right? It's like they're getting into trade finance, right? They've already started to think about issuing letters of credit for oil trade, right? And so that is where you move from this being a stablecoin market, principally, for crypto on and off ramps, and then, marginally going into cross-border remittances, and then maybe for tokenized, sort of exchange with, a stablecoin onshore market. Once it gets into the energy and commodity system, that's like the next 10x, right? And so that would be, maybe in the 2030s, right? Where if this first phase is successful and stablecoins move from, a few $100 billion to, a few trillion, then the next leg up is when stablecoins move from a few trillion to like 10 plus trillion. And I think it's important to think about the relationship between that and Bitcoin, right? Because if you just think about the elasticity and kind of liquidity multiple associated with that correlation, I mean, the Treasury Borrowing Advisory Committee's forecast of a $2 trillion stablecoin market, if you assume all else equal, roughly implies somewhere between like a $300,000 and $800,000 US dollar Bitcoin. So take the middle estimate, that's 500,000 Bitcoin, $500,000, Bitcoin price. This is essentially the implied Bitcoin price by the US Department of Treasury's stablecoin forecasts. Now, of course, if you put another 10x on top of that, you get to a very different world where essentially the US is kind of re-architecting a digital money system that is designed to sort of structurally graft it to the legacy dollar debt system, but recollateralizing it, right? And also allowing, its rails to penetrate around the world and kind of lock people into a system that, from a certain perspective, right, it is represents our values. I think this is the tension, right, for Bitcoiners, is that the Genius Act, right, like requires that the U.S. government be able to like fully surveil, burn, seize and freeze any stablecoin transaction globally, right? And they can't do that for Bitcoin. and so this is going to be the next tension here between the strategic alignment of incentives around this kind of monetary debt system kind of being recollateralized and Bitcoin kind of helping with that process. Everyone's on board with that. I think where the strategic and kind of security interests may start to diverge is this perspective on how much freedom, right, will be permitted in that system or will be negotiated in that system.